That if you do, you let me know. Because complexity eventually builds on top of simplicity. So we're all clear on futures and stocks and the basics of those things. Okay. Since no one's saying anything, I'm just going to assume that's a yes. Okay. So today we're going to. Yeah, but Alan, based on you sent me an email about the futures and you were wondering about like still leverage and all of that, is that correct? They're just the thing is that you don't have to worry about any of that. So don't get caught up in the fact like I kept talking about leverage. It was just so you understood that in futures, the leverage in futures is I'm sorry, my computer just did something really weird. Hopefully you guys can still hear me. But the leverage in futures is different from the leverage in stocks. Okay. So, um, and all you need to worry about is what you have to put up for the contract. That's it. And then the point value is basically just how you calculate your risk. And there's different contract months, which just essentially allow you to hedge yourself further out. No, the money gets taken. Think of it like a token. So basically, if you buy an SOP contract, $5,000 from your account is going to just be missing. But the value of the contract is different. So for the S&P, for example, it's $50 per point. But they're going to hold on to that $5,000 until you sell that contract out. There's, what do you mean, time value to futures? There's no decay like there is in options. The only thing is that the current month contract will expire. That's it. Eventually that contract will cease to exist just like an option, but there's no time or theta decay or any of that nonsense slash bullshit. Okay? It is what it is. The value stays the same. So if you're holding a contract, yeah, nowadays when rollover does happen, it's generally around the same price because there's no gap usually between days for a lot of the futures contracts like there used to be. But sometimes it can be at vastly different prices. So that is a possibility. Don't just assume like it's always going to be around the same price. But when you're trading, you just have to understand like whatever you're trading, you know, if you bought down here and you're in money and you still want to hold on to your position, you're going to have to roll it over. And if you want to still be in your position, you're going to have to sell out of that contract and buy the next contract. And obviously, that's going to be way higher than your entry. But you've already basically locked in profits for that move up. So it's essentially the same. So I don't know. I don't think it's that hard to understand like what the futures contract is, and like you're just putting up money for the contract, and then what that contract is what it's worth. And then you the only thing you really have to be concerned about is like when rollover happens, that if you're trading, you're just going to be on the front month contract always, and that just requires you to either call your broker or look it up on the internet of when rollover is going to happen. It's that simple. Yeah. You were getting caught up in this whole like leveraged thing and trying to figure it out. I mean, all of that is doesn't matter. But the only reason I harped on it is because I want you to understand that people that come from the stock world who do absolutely no research whatsoever and think that they know things assume that futures are risky, more risky than any other asset class because there's quote unquote leverage. It's like, dude, your leverage in the futures market is not the same as your broker giving you 4 to 1. That's the difference. And people confuse leverage and margin. So that's why I harped on it, because I just want you to understand the difference between leverage in the futures market. It doesn't really affect you. Like, you still have to put up a cash money balance of X to hold that contract. You are just controlling, in theory, a certain amount of money. It doesn't affect, it's, you can't trade that amount of money. You don't have access to $100,000. But like in a stock person's account, if they're trading on margin or they're trading on leverage, so to speak, in that specific case, they can do 4 to 1 of their account. You can't do that in futures. It's a huge difference. And in theory, in my opinion, if you like, that's why I think forex is risky. That's why I think people who trade stocks, that use margin is risky to hold things, because they're trading, 4 times what their account is worth. The futures market, you can't do that because you can only trade the amount of money that you have in your account, and you can only hold the contracts for that exact value. And you can control risk by, yes, where you put the stop. But we're going to talk about this, but stop losses, you guys have to get out of your head. Like, they can be skipped through. Like, if them, that can happen. Does it happen all the time? No. Like, it happens like 1% of the time, but it's possible. But your stop value is always going to be based on the tick value of the contract. So if you were put a stop at $100, that's 2 points in the S&P. That's 10 cents in the crude oil market. So you have to really follow that chart and understand like what the contract's value is worth per tick, which is what we went over last week. Okay. So it's like Chuck E. Cheese. You pay money for a token, and that token has some kind of intrinsic quote unquote value of X dollar amount per tick. So you got to put money up, and then when you hold that contract, it has some kind of value pertaining to that market per tick. Or per point move, if you want to say it like that. Okay? So, let's get on with the show. David says, so instead of typing in a dollar amount for a stop loss on a futures contract, we could put a stop loss at a point where you want to exit the position. Yeah, but it's still going to be a dollar amount. Always reference this graph that we talked about. If you're still not understanding it, please go back and watch it. I think I explained it pretty clearly, which is this point value is 1 point in the S&P. So you put up $4,840, that gets taken from your account. The point value, meaning 1 point is 50, it moves in 0.25 increments. Every 0.25 increments is $12.50. So if the S&P goes from 1800 to 1801, it's going to go 1800, 1800, 1800.25, 1800.50, 1800.75, 1801. And that whole thing, it moved up from 1250 to 25 and so on and so forth up to $50 in that four tick movement. And the 1 point value is 50. In crude, it's different. Okay? Crude is 10 cents $10 per 1 cent move. So if crude goes from $40 to $40.10 and you're long, you would have made $100. Okay? So that's how you read this chart. It's pretty simple. What confuses people is they get caught in this like tick value thing, and it's just telling you how it moves. So the S&P moves in 0.25, and every 0.25 is $12.50. So if you put $100 stop loss on something, what are you essentially doing? You're essentially saying I'm only willing to risk 2 points in the S&P, which is really tight. Okay? You put $100 stop loss in crude oil, you're only risking 10 cents. Technically on crude. Okay? Which those kinds of stop losses are way too tight because the inherent market risk and for like the S&P 500 is 10 points. Meaning on average on a given day, the S&P moves about $500. Lately it's been about 17 points. So you cannot escape that kind of stuff. No, you would literally type in like your stop loss where you would put it would be at, so if it was trading at like 1800, you would put it at 1798. Okay? So you would just put it at that amount, David. Okay? You just have to, the thing is like it may sound confusing, but like once you start like actually trading this stuff and just look at it, like you'll just know off the top of your head. You'll know like, okay, I'm long here. Based on whatever else I did, I want to take like $1,000 stop loss. Well, that's 20 points in the S&P. So from wherever I'm long or short, I'm just gonna type in my stop at X point. Okay? It's gonna be different. But once you do it, like it becomes second nature, just like anything else. It's just you need to understand how it moves, what you have to put up, and then like the point value of each of the contracts. Casey says, I can understand why you like futures. I think it would make sense when after we trade a few contracts. Of course. It's just like anything. But I just want to make sure we're all clear on this stuff before we move on. Because I know that it's not like this is hardly ever talked about in finance to at least retail traders. Like 90% of the stuff that goes on the outside world is all based on the stock market. And this is obviously based on the stock market, like we're trading the S&P, but nobody talks about like the futures market. And so contracts work just like shares, but they have their own like differences. Okay? So, speaking of differences though, we're going to go into options today. Okay? Now, please stop me when, if you have any questions while we're going over this material. Okay? Options are a little bit more familiar to people. Okay, you need to understand something though. I don't trade options generally ever. Okay? There are rare occasions where I will trade options, and it's just because I don't want to buy or put up so much of the stock. Okay, because stocks I'm interested in are usually expensive. Okay, so it's just a tool. So, what are options? So, options are basically a privilege sold by one party to another that gives the right but not the obligation to buy a call or a put of a stock at an agreed upon price within a certain period or on a specific date. Stock options options involve risk and are not really suitable for everyone. Okay? And you'll see why. So a call option is the right but not the obligation to buy a stock at a certain price. So this would be like going long something. And a put option is the right but not the obligation to sell short a stock. So if you buy a call, you're going long the stock. If you buy a put, you're technically taking a bet against the stock. Okay? Holders of calls and puts can exercise the option to buy or sell the underlying security, or they can let them expire worthless. So in this very simplistic case, okay, options are a lot like futures contracts in terms, unlike shares, options and futures contracts expire. Okay? Now, unlike futures contracts, though, futures contracts expire when expiration happens, they have some kind of value. Okay? When options expire, they can be zero. Okay? So, if you're wrong on an options play, you can lose all of your money. Okay? In a futures contract, if you're wrong, you're still going to lose money, but it's not going to just go to zero. Okay? So, understand that difference. I, nor most people, do not buy options to exercise them, meaning I'm not going to wait till expiration of my options. Instead, I buy them to sell them for a higher price before expiration date. Okay? An expiration for options, for all options, generally is the third Friday of every month. Okay? Make sure you keep that in your mind if you ever trade options. Options expiration is the third Friday of every month. Okay? So, how does this all work? So, as the underlying stock goes up, the call option goes up in price and a put option goes down in price. Same as if you were to buy or sell short. As time elapses towards the option expiration date, calls and puts go down in price. Okay? the ratio of the change in an option's price to the decrease in time to expiration. Since options are wasting assets, their value declines over time. As an option approaches its expiration date without being what's known as in the money, its time value declines because the probability of that option being profitable or in the money is reduced, also known as theta and or time value decay. And we will look at the difference between in the money and out of the money. So as volatility in the underlying stocks goes up, so does the price of the call or put goes up. As volatility goes down, the price of the call or put goes up as well. Okay? Is this confusing to anyone? So basically, calls and puts are like buying or sell short a stock, and that options also have something called theta decay, which means that over time, if you're wrong, even if the stock doesn't go anywhere, you're basically against the clock, and your options can go to zero just based on theta decay. Okay? And options also have volatility just like anything else. But they're generally reacting to the volatility of, is the stock going astronomically up or astronomically down? Okay? And to give, well, I'll talk about that later. So another term that you need to be familiar with in terms of options is vega. Okay? So this is the measurement of an option sensitivity to change in the volatility of the underlying asset. Vega represents the amount that an option contract's prices change in reaction to a 1% change in the volatility of the underlying asset. Volatility measures the amount and speed at which price moves up and down, and is often based on changes in recent historical prices in trading instruments. Vega changes when there are large price movements or increased volatility in the underlying asset, and falls as the option approaches expiration. Vega is one of the group of Greeks used in options analysis and is the only one not represented by a Greek letter. Okay? So, those are the terminologies that you need to be familiar with. Okay, like I said, I'm not a complex options trader, so I don't really pay attention to any of that. Okay? Other than I want to be long this stock, I want to buy a call option, and what we're going to get into is what's known as ITM and OTM right now. Okay? But understand those terms because you need to know them and understand them in terms of there is time decay, and basically Vega measures volatility. All right? So for a call option, when the option strike price is below the market price of the underlying asset, so this is what's known as in the money. And then for a put option to be in the money is when the strike price is above the market price of the underlying asset. Okay? And we're going to go over like a table that shows like what this all looks like in real, like in a real stock, so you can understand what, where the strike price is. And the strike price is basically where you're buying the option. Okay? So if Apple is trading at $140 and you think that it's going to go to $147, you would buy a call option at the strike price of $147. Does that make sense to everyone? If you thought Apple was going to go down and it was going to be, you thought it was going to go to like $140, you would buy a put option at a strike price of $140. Okay? So, in the money means that your stock option is worth money and you can turn around and sell or exercise it. For example, if John buys a call option on ABC stock with a strike price of $12 and the price of a stock is sitting at $15, the option is considered to be in the money. You can do that. Okay? This is because the option gives John the right to buy the stock for $12, but he could immediately sell the stock for $15, a gain of $3. But if John paid $3.50 for the call, then he wouldn't actually profit from the total trade, but it's still considered to be in the money. Okay? So if a stock is trading at $15, like in this example, and you can buy a call option that's in the money already at $12, at a strike of $12. But you would have paid $3.50. What's the danger of doing that? The danger of doing that is anything that is in the money, okay, generally has a premium. All right, and we'll discuss that later down the road, but just keep that in the back of your mind that anything that you buy that's already what's known as ITM has a premium when you buy it. So there's another term which is called out of the money, and this is what I tend to do the most when I buy options. Okay? We'll get into that in a second, Emily. I just want you guys to be comfortable with the terminology first. Okay? So out of the money, or OTM, can be a call option with the strike price that is higher than the market price of the underlying asset. Okay? Or a put option with the strike price that is lower than the market price of the underlying asset. So if Apple is trading at 140 and you buy a call option at 140, or call or put at 140, that's considered to be in the money. If you bought the call option at a strike price of 147, okay, in a call option scenario, that would be an out of the money. Okay? And also for a put option. All right? Does everyone understand that? So in the money, out of the money, calls and puts. Okay? So an out of the money option has no intrinsic value, but only possesses what's known as extrinsic or time value. As a result, the value of an out of the money option erodes quickly with time as it gets close to expiration. If it's still out of the money, it will expire, generally worthless. Okay? So, how to calculate risk and reward when you're buying calls and puts are as follows. So, if you buy one contract, okay? So, a contract in this case for calls and puts, that's what it's called. Okay, so you buy one call, one put, one contract is equal to 100 shares. Okay? If you buy 10 contracts, that would be equal to 1,000 shares. If you bought 100 contracts, that would equal to 10,000 shares. Okay? So buying a call or a put, the trend of the underlying stock must be in your favor, or the time value money will erode the value of the option. So buying calls and puts, just from the get-go, the odds are against you. Okay? Just straight out the gate. All right? So, remember when I said that if you bought an option that was in the money, right? So if something's trading at $15 and you buy a call option between $0 and $15, everything in between there is going to be in the money. Why? Because the contract has already basically, it's higher than any of those prices that you're choosing, okay? And when you choose to buy in the money options, okay, or you buy puts that are in the money. So if Apple is trading at $140 and I buy a put at $139, okay, That price has already happened. All right. And that's the way you kind of have to think about it too, because it's like in the money is basically where price has already been, and out of the money is where price has never been, essentially. That's the way I like to think about it. So when you choose which strike price or where you're going to buy the option at, any if price has already been there, it's already in the money. If price has never been there, it's going to be OTM or out of the money. But when you buy options in general, or even options that are mostly ITM, you're gonna pay what's known as a premium. Okay, and this is where it can get a little bit confusing for people. I hate premium. I don't like paying up for anything. Okay, I'm a cheap ass. All right. Overall, the thing is that premium is always going to be on ITM options. Always. So, premium on an option is the amount of money that an investor pays for a call or a put when choosing to go long. Either long a put or long a call. All right? There is some kind of premium built into the price that you're paying. All right? So as we just learned, the two factors that affect an option price is intrinsic value and time value. And it's important to note that options have intrinsic value when they are in the money. To calculate the intrinsic value, so for a call, you would take the underlying stock price divided by the commodity price minus the strike price. Okay? And the put is going to be the strike price minus the stock price over the commodity price. Okay? So if I was interested in the stock that was currently trading at $42 and I bought a call option with the strike of 40, my options would already be in the money. Let's say I paid $5 per contract, okay, for the call option. So the option's intrinsic value in this case is $2. All right. 42 minus 40 gives us 2. However, the time value makes up $3 of the $5 that I paid in this case. So in this case, my option will have protection of $3 because that is what I'm paying for the price value decay protection. Okay? Think of it like the mafia. The more time and protection you buy, the higher the premium will be. Premium in this case was almost $3. Okay? But what happens when it goes below, if it went below $40? What do you think is going to happen to that premium? Can anyone be logical about this? So if you paid for protection, but the stock goes below $40, what do you think happens to that premium? Even if it went to 41, it wouldn't matter. So the stock goes down $1. The premium increases. So it goes below $40. So you bought it at 40. You have $3 of protection. Now the stock goes to 39. So now you're wrong, okay, in the direction of where the price is going. You paid $3 in protection. And so what do you think happens to that protection when you're just dead wrong? And now you've been wrong for a couple of days now. So now you have to deal with the clock is ticking. So theta is kicking in and basically eroding the value. Alan says, but a call is not protection from the stock going down. No, I'm talking about premium, Alan. Okay? Exactly. In this specific case, what we just did was we calculated how much it how much, so the underlying value of the contract was $2. Okay. That was the intrinsic value when we paid our money. But we paid $5. So the premium we bought, because the option was already in the money, was worth $3. So we paid up. We paid extra because it was already ITM. But when you are wrong and long on an option and it's in the money and you bought that protection, because most people don't do this calculation, okay? They don't even understand like that their option is really worth $2 and they've paid a premium of $3. So basically they've paid like almost 1.5 times the amount of what the option is actually worth. So, and they're doing that because they bought it in the money, and therefore in theory the way that they think about it is that as long as it doesn't go below their strike price, the value of the option won't change that much. But that's wrong, because you have like for a stock to move, $2 to $3, especially in the place that most people trade options, happens all the time. Okay. So when you're long, wrong, and now you have theta decay and it goes under $40, all that premium is gone. You just lost $3 right off the top immediately. Okay. So it's a dangerous game, and this is why I hate buying in the money options. Okay. So you need to understand that when you're buying a call or buying a put, so whatever direction you're trying to bet on the stock going, and you are like, well, I want to decrease volatility and I want to decrease this and that, you can buy in the money options. But understand and do this calculation, it's pretty simple, of when you're buying an ITM option, what the intrinsic value is of that option on that day, okay? And what you're actually paying for premium, okay? Because you'll realize, like, holy shit, my option's only worth, in reality, $2, but I'm paying, $10 per option. So I'm paying basically $8 of premium. And if I'm really wrong, boom, that's gone right off the top. Okay? So be really careful. And this is why I hate premium and I don't like to pay for it. Okay? And like I said, when I buy an option, I'm buying in the expectation for me personally, over the next 30 to 45 days, that price will get to X place. Okay? And if it doesn't, I lose all of the money I put up. Okay? I don't do anything complicated with option strategies. All I do is I take a sizable bet and I buy a call or a put, and I say, and at a strike price where I think price is going to go. Okay? And that's it. And I either make money or I don't, but I'm always buying out of the money options. Why? Because I don't have this premium cost built in. And plus, out of the money options are super cheap. They can sometimes be pennies on the dollar. Okay? So, that's why I choose to do that. And this kind of goes into that as well. So this is why I never buy ITM or in the money calls or puts. I always buy OTM or out of the money calls or puts. OTM options also have inherent risk of failure, as you need directionality in your favor for the option to work out well. The advantage of buying an OTM option is less premium, which equals less capital. And the way I use options on the long side, meaning I'm buying calls or puts, I buy options with a strike that is out of the money. I give myself 30 to 45 days to be right. I do this because it gives me more time to be right, and it also helps curve theta decay just a little bit. Okay? I need to have a thesis, or generally an edge, of why the stock will move up or down in the next month, such as earnings or maybe some kind of macro event, I only use capital I'm willing to lose 100% of. Remember, OTM has a high risk of failure. However, it cuts premium. Remember, when you buy calls or puts, you can never lose more money. So when you're buying calls or puts, you can never lose more money than you put up. Your upside potential is limitless and your downside potential is capped. So if you put $1,000 into an option, that is the maximum amount of money you can lose. However, if you are getting fleeced on premium, that the odds are severely against you. Okay? David asks, do you have to put down an amount of money like you would a futures Yeah, just everything costs money, David. So if you're buying shares if you buy 1,000 shares at $1, that's $1,000 you're putting up, correct? I don't understand how that's different than buying a contract for a future or buying an option. So if you bought one option contract, if you go back to our table here, if you bought one option contract, that's the same as buying 100 shares. So if the options contract was worth $1 and you buy one contract, you're putting up $100. Emily asks, would anyone ever exercise the option contract? If so, why? You mean waiting till expiration, Emily? Anytime you trade options, David, they generally make you have a margins account. Okay? But we're going to get into short selling these things and why people choose to do that. And that will kind of answer your question, Emily, which is why people wait to expiration. Okay? And Norman says, so it's all or nothing with options. Can you take partial loss? Of course you can do that. Of course you can do that. But for me, my mindset is this is how much I'm willing to lose. And you need to understand something about me as a trader, okay? Anything I do always has a stop loss amount in a stock or futures, or in an options, in an example of an options thing. It's the total amount of money I'm willing to lose, and I will take that loss. Okay? For me as a trader, because I generally always have a quantifiable edge, meaning I know my risk reward and I know how much I'm willing to lose, I'm okay with that. And so in this case, like, I never try to finagle the market that much. Okay? When something is supposed to be long and I want to take that trade, I will take that trade. It either works or it doesn't. Period. I either make money or I lose money. And that, my mindset is always focused on the loss. Okay? And what does that mean? That means that if I'm not comfortable with that loss, then I shouldn't even be trading that market. And a lot of people try to be like, ooh, I got out here. Ooh, I got out there. Ooh, I saved myself some money there. Maybe in a day trading world, that would make sense. But I'm not a day trader because there's not that much money to be made during day trading. And as we go down the road, you'll see like the people that choose to day trade and they flip flop and they try to get out real quick. Like, all the money is always made generally by holding things. Okay? Period. And so what does that require of you? That requires of you to put a stop loss in that you have to hold, right? And a lot of people don't like that answer. But if you're not comfortable with the risk, then don't do the freaking trade, period. Okay? If you can't lose $1,000, then don't trade whatever you're trading. Because you have, like, all trend and all money is a function of time. Write that down in whatever notebook you write. All trend is a function of time. So if you want to make money in the market, what do you need? You need time. Okay? And so you need to remember that like you can get out of a trade. Of course you can always get out for a trade. But 99% of you are getting out of a trade because you have some kind of magical pain threshold. And the market doesn't give a shit about that. All right? Not to be blunt, but that's the truth. And so you have in terms of options, I trade options the way I always trade everything else, which is like this is the probability of this happening and this is how much money I'm willing to like lose, or in most of my stuff is automated. So in that case it's pretty much like depending on the system, like I just understand that at any one given trade my maximum loss doesn't mean I'm talking about max loss is generally $8,000 to $10,000. Period. That's the worst case scenario. All right. On average, it's like $1,500. Okay. So that comes down to like making an edge, and we're going to get into all of that. But the reason I trade options the way I do is because that's just my personality. Okay. That doesn't mean this has to be your personality. There's tons of things that you can do with options. I'm just here to teach you the basics of what options are, the lingo of options, and how I trade them and how I see them. Okay. Like, do you guys remember when Apple went to like $90? Okay. Like Apple, from an intrinsic value, meaning the value of that company in a bull market, was trading 75% less than its fair value. Okay. What did I do? I bought OTM options, like $5,000 worth of OTM options, out of the money at a strike price over the next 30 to 45 days. Okay. Going out to about like $95. Okay. And I was fucking insanely right on that. Okay. So, but I didn't care. All right. There's a high probability that even at that kind of acceleration down, that we would have at least seen like a bounce up. So now when you're right like that and price exceeds your strike price, do you make more money? Yes, because of two factors. One, you're above your strike price. So you bought it OTM, so you paid, pennies on the dollar. Secondly, you're really right, meaning like you're at $97, $100, let's say, of where it's trading. So you're in the money. Now people are paying protection for it, so you're good. And you also have the volatility factor. Okay?